Well, hello, everyone, and welcome to the Mid-Year Real Estate Review with Paul Brewbaker. We're so glad you could join us. My name is Patrick O'Neill. I'm the principal broker at Luxury Homes International, and this is actually the 13th year that we have hosted this event. And just found out this particular event, we have over 900 attendees on the Zoom today, which is pretty amazing. And I want to give a very special thank you to Crystal Bisay and the entire team at the Hawaii Association of Realtors. You do a great job in putting this together and all the other events throughout the year. We're truly grateful, Crystal. So thank you so much for everything that you do. Also have to give a big shout out to all the agents at Luxury Homes International. And a big congratulations through your hard work. We've appeared on all 4 of the top 25 lists in Pacific Business News, including largest real estate companies in the state and highest price sales in residential, commercial, and vacant land sales. Great job, everyone. Really well done. And if everyone on the call, if you know of anyone, we have 2 agent openings in our Honolulu office. For more information, you can visit our website, which will be posted in the chat box, or you can reach out to me directly. After the presentation, all the attendees will receive an email follow-up with copies of all of Paul's reports and documents, as well as a video replay. So stand by for that, probably come out the next day or so. And a big thank you to our sponsors. Without them, none of this would be possible. We greatly appreciate all the support for this event and for all the others throughout the year. Howard Hughes has been supporting this event for many years in a row. And with some really exciting news coming out of Ward Village, we have the principal broker and executive vice president of sales and strategy, Bonnie Wiedemeyer. Bonnie?
Hi, everyone. Thanks for having me. I have 3 minutes to talk, which, if you know me, you know that's hard. So I'm going to give a quick update on more neighborhood things than condo things and share some new stuff and some stuff you probably already know with some good visuals. And I'm not surprised you have almost 900 people. When Paul speaks, I always want to come. Can everyone see that?
Yep, got it.
Great. So a Ward Village overview quickly for everyone. I think one of the exciting things going on is you're starting to see just quite a lot of progress. There's a lot of cranes and construction. So I want to give you an update about what's happening and what you can look forward to. One of the things I also love is looking at these renderings and seeing what an impact our parks will make. It's great to see that kind of the green space in these towers to be kind of floating in green, connecting with Ala Moana Beach Park. I didn't have a chance yet to put the overhead walkway in here, but you know that's also coming currently to be completed in 2023. One of the first things about Ward Village, I think, to know is that very unusual to have 60 acres in the middle of the city. I mean, Hudson Yards in New York is 28 acres, to give you a sense of scale. So that happened because there was one family that owned it for such a long time. And that's a great story. It's super interesting. I think people always want to know about the history of where they live. But what does it mean for people? What does it mean for us, whether you buy here or just come and enjoy it? A lot of it means that because we have one owner here, Howard Hughes, we're able to make very large streetscape improvements and parks and all kinds of things that benefit not just our homeowners, but also the public realm and everybody. So one of the things I like to do to describe this is if you've enjoyed the walk from South Shore Market to Merriman's and that sidewalk, you know, part of what's so nice about it is that it's shaded and that there's this nice landscape buffer between the sidewalk and the street, which you can walk with a 2-year-old. You know, it's just very nice. That similar feeling will go all the way down Oahu and all the way down. So Oahu Street is actually narrowing from 4 lanes to 2 lanes to make way for that sidewalk. And if you see construction in the future here, that's part of what's going on and very exciting. And then Victoria Ward Park, Mauka, will be delivered with the Park Ward Village, and Victoria Ward Park Mackay will be delivered with Victoria Place. So all in all, this is 3.5 acres of open space with great topography that will connect to this overhead walkway. And all of this I think is very exciting, just having more open and green space, walkability, access to the water, free parking, all those things we can all enjoy. And usually you hear me talking about our towers, and I will a little bit today, But I think those are things that make a big impact. And here's some examples of, it's 600 feet wide at its widest. Other images of our parks, just to give you an idea of scale. I'm watching the time and moving quickly. One of the other things I wanted to note was how many great openings we've had in the neighborhood and retail. I mean, I think one of the things about our retail is it's experiential. So in other words, of course, people have websites, you can order things online, but we want to find things that you can have an experience and you aren't just able to order everything online. I've been in many cities in the last few years where I'll go to my favorite streets and find that everything there, I could buy it there, or I could just look online because it's a national chain. So we do have some national chains, but a lot of really fun things, coffee shops and new boutiques opening all the time. And of course, Ali'i, I'm going to talk very briefly about our towers. Ali'i is currently selling. They've been selling very well, and our staff is on site every day, so it's easy to show if you're showing a resale. Ko'ula is about to close. Can't wait to show it to you. Really, can't wait to get you in. We only have a handful of homes left there, but if you want to see them, you can see them on Saturdays with our team. And the Park Ward Village, thank you so much. What can I say? Just incredible support. Victoria Place is sold out. And our next project is working its way through approvals and is not quite approved yet, but it's right here called Kalai. We're really excited about it. Can't wait to show it all to you as soon as we can. That's all I have. Thank you very much for having me.
Wow, Bonnie, that was the fastest I've ever seen you do that. well done. And Bonnie, on behalf of the brokerage community, thank you for doing such a great job with outreach and making it so easy for our agents and everyone to come down there and taking care of the clients. Everybody, every time has been, I think, under-promised, over-delivered. It's just an absolute joy. Thanks for everything going on over there.
Thank you.
Yeah, really nice. Okay, let us continue on. Title Guarantee has also been a sponsor of this event for several years. And if you're not aware of this, Title Guarantee has a whole library of reports and information that they make available to the community. This particular one is a very interesting report. It highlights the top foreign buyers in Hawaii. If you're interested in this or the other reports that they put out, contact your local TG branch. We also have a link to their website in our chat box. So check that out, and thank you very much, TG. Now, the team from Guaranteed Rate, they've been sponsoring this event since the beginning. So 13 years ago, and Anders and I go back probably 25, 30 years ago, sponsoring other different things. We're really happy to have you. And you're the hot topic of the day, Anders. So where are mortgage rates and what's happening right now? What are we looking at? And this, please welcome. This is the regional manager, Anders Hostelli from Guaranteed Rate. Anders.
Yeah, thanks, Patrick. Yeah, the interest rates, I can start off with that, obviously. I mean, mortgage rates for an owner-occupant conventional loan, it's in the high fives, about 5.75 with 1 point. VA rates are in the low fives right now, but all of and have seen it, but interest rates are about 3% or more than 3% lower a few months ago. So it's been a dramatic increase in mortgage rates. We'll hear more, obviously. Paul will talk about going forward what mortgage rates look like, or interest rates. I'm interested to see what he has to say. I'm hoping that rates will kind of plateau here and kind of come down a little bit. At least we saw a little improvement today. But as far as a guaranteed rate, we've been here. There's a whole group of us that, we were previous companies and so forth, but we're here located in Hawaii. There's about 30 loan officers. We have branches on Oahu. Also, we have a branch now in Kona, and we have 3 in Maui. So we're here to service all your needs, clients' needs. Thank you. Our market share continues to go up. We kind of track that and look at that. And it's thanks to all of you for your help, support, and referrals. We do have a fast track program we've just rolled out, I just wanted to mention, on conforming loans, where we can get a loan ready to close within as little as 5 days. So, talk to your loan officer at Guaranteed Rate for more information, or you can always reach out to me and I can put you in touch with someone. So with that, Patrick, back to you. Thank you.
Anders, thank you very much. And thank you for the support, not only for this, but for everything throughout the year. Truly appreciate it. All right, and also welcome to all the members of the Hawaii International Real Estate Council that are joining us today. The Hawaii International Real Estate Council is an organization that puts on educational events throughout the year, focused on the various issues that involve clientele buying from international markets into Hawaii for buyers and sellers. We have an exciting event coming up July 20th. We have 3 top-level brokers, one in Hawaii, one in California, one in New York, to talk about the nuances and other considerations working with clients from Japan, China, and Korea. If you're interested, check out the link we posted in the chat box. Here's a couple of other events coming up later in the year, some things on taxation, immigration, and one of the most popular, the geopolitics shaping Hawaii with Ralph Kosa. If you have never attended that, check it out this year. It's fascinating. If you're interested in becoming a member of the Hawaii International Real Estate Council, again, check out the link in the chat box, or feel free to reach out to me directly. Okay, and now on to our featured speaker of the day. And by the way, if you have any questions for Paul as we go through this, please post those in the Q&A section, and we'll try to get to as many questions as possible, time permitting. And if you don't get enough of Paul today, and you want to keep updated and further insights, Paul and I release a Hawaii housing report every month. You can find that on YouTube and also access it through our website. So without further ado, principal of TZ Economics and one of Hawaii's leading economists, my good friend, Mr. Paul Brewbaker. Aloha, Paul.
Thank you, Patrick. Aloha, everybody. Mahalo to all the sponsors, as Patrick indicated, and not just for the event this year and the long sequence of events. I've been happy to have been invited to join you for. But for supporting my work over the years, I realize now, looking back over the long arc of this extraordinary run I've had back here in Hawaii when I came back in the 80s, how many of you in the audience and the companies with which you're affiliated and some of the sponsors here today, how the work I've been able and privileged to do with them and for them has cumulatively built into quite a body of knowledge that I'm happy to be able to share here. I'm going to jump right in to the slideshow. I do have, you know, as usual, I have more material than we can really get through. So I've included some of that in appendices, which we may have time for, we may not have time for. And Patrick, remind me, when should I cut myself off for Q&A? What time are we looking
Yeah,
at?
I think we'll take it out till 45 past the hour, and okay. We'll just see where we're at, and we're going to wrap everything up by 3, if not sooner.
Yeah, let me somebody remind me to take stock at
I'll remind you, Paul.
And yeah. So as Patrick indicated, a PDF of the slides I have here today will be available to participants, and thank you again for joining us. It's pretty up to date. Patrick sent me an email this morning about mortgage rates that Andrews was just talking about, and that got me thinking. So I've put some data and did some more work on the slides this morning. But first, we need to take stock of the pandemic. It's not over yet, and I presume we're going to see my slides now. Are we on board here?
Yes. Good. Yep, we can awesome. See.
So now I'll have to figure out how to advance. Yeah, so let's not forget the pandemic is still there. The BA.2 wave is subsiding. Maybe you missed it. It actually happened. It was worse than Delta in terms of case counts, but not as bad as the 2 prior waves in the last year in terms of mortality. If somebody knows how to get hospital data, please tell me, because nobody at the Department of Health or the Hawaii Emergency Management Agency has been able to tell me. But we can pretty much link up what's happening with case counts, although the measures aren't that good now because there's home testing and those numbers aren't reported. But we can pretty much link up things like case counts and the positivity rates, which are very high right now, to economic outcomes. And I'll start with just a quick look at the data. So if for some reason you think there's not going to be any more waves, I'm sorry to say that's what's happening. And the BA.4 and BA.5 wave, which is BA.5 is going to be the worst of any of them because it's going back into people's lungs and it's overcoming your immunity. You only thought you were immune. And that should be hitting us right about the time school starts, which is perfect for spreading it across the island. So the problem with these recurrent surges of infection, and we're talking, there's only 2 people in Hawaii dying every day of COVID. Only 2. Like, you're dead and you're dead. And then tomorrow you're dead and somebody else. And the next day your mom's dead. I mean, 2 people a day, that's considered low. It's important to understand that until last week, Hawaii had the worst COVID incidence of any state in what is the country among the advanced countries with the highest incidence in the world. Now, currently, I think Alaska just moved ahead of us last week, and then I think I saw Colorado moved ahead. So we're only the 3rd worst state in America. But this thing is real. It's affecting travel. You won't read this in the newspaper, although they did. I have friends, there that are good reporters, and they tried to convey my ideas a few weeks ago in an article that was kind of like, well, here's what Brewbaker says. But you can just look at the data. So, I mean, we have daily passenger counts and we have daily visitor counts. So you can just look it up. Actually, we used to have daily, what did I say? We have daily passenger counts and we used to have daily COVID counts. Now the state only publishes them weekly. So what I've done here is I've taken the weekly COVID counts and then I've mapped the daily passenger counts into weekly passenger counts. I have to seasonally adjust the weekly passenger counts, and that's challenging at high frequency. And you can see that because if you look at the 0 line there for passenger counts, it's kind of averages 0 at the bottom of the, when COVID first hit in the spring of 2020, spring and summer of 2020. But once pre-flight testing initiated and pre-flight testing worked, you can just see from the COVID data, it worked to keep COVID pretty much out of Hawaii. Now it's been dropped, so COVID is just coming to Hawaii with airplane passengers. But each of the COVID waves of the last 12 months with vaccination, now this is post-vaccination, has been associated with about a 15 to 20% decrease in passenger travel volumes, and not so much the current wave. And as I mentioned earlier, the current wave, while it has higher incidence, it's not as lethal, right? It's not killing as many people as the last 2 waves. And so there's a perception that it's maybe not all that. I'm just the warning again that BA.5 is going to be worse, and maybe worse than all the others, and maybe should be here in about a month. I mean, in force, right? 4th of July weekend, we'll all spread it around, and then a couple of weeks, the body counts will start going up. But the passenger counts, you see, get pushed back. And by the way, the magnitudes you're looking at there, those are like 9/11 events. So it's like we had a 9/11 last summer, and then we had a 9/11 last winter. And this spring we had a small, you can see that it sort of flattened out what was otherwise an upward trend. Not as virulent a variant, and therefore not as repressive for travel volume. But tourism is still running at about 90% of its potential, like 90% of the pre-COVID 2019 or 2018 benchmark. And that's going to continue to be a problem going forward. It's not just tourists. Okay, resident behavior has changed as well. So we have more high frequency data now available. This data set's from Google. It's smartphone mobility, so that Google knows where your smartphone is. And they publish the anonymized data showing how much time Hawaii residents, these Hawaii residents now, how much time people spend at retail locations, including food service establishments, and at recreation establishments like gyms, relative to the pre-COVID benchmark of January 2020. So January 2020 is kind of the 0 line. And then currently behavior is such that people spend about 80% as much time as they did pre-COVID in retail, food, service, and recreational establishments. And you can also see how each wave, in particular the Delta wave last summer, the Omicron wave last winter, and the BA.2 wave this spring, have pushed back on the economic recovery that in the intervals in which COVID subsides has slowly been grinding its way forward. And of course, a lot of us are just not even going to the office anymore. We're going to come back to that in a second. So, you know, if you're a commercial real estate property owner or manager, this is a challenge, particularly if, as it looks now for the last year or so, as if this is a permanent change, right? A structural change, not just a passing response to aperiodic waves of COVID infection, but something that is starting to look like it's permanently a 0.8 or 0.9 of the way things used to be. And that's a theme, again, as I mentioned, we're going to come back to it. Finally, just more high frequency data on job postings. And so I don't know what databases these people scrape, but Burning Glass publishes this high frequency. I think these are monthly data that I indexed to, again, January 2020. So job postings have been rising relative to the pre-COVID benchmark. They are higher, significantly higher, right? People are looking to employ people. Avis on Kauai is paying, Avis Rent-A-Car on Kauai is paying a $3,500 signing bonus if you want to go over there and work for Avis. So, but again, the cycles are clear. Every time there's a variant wave, Delta, Omicron, and then the spring BA2, job postings are pushed back temporarily until that wave of infection subsides. So this is having impacts on travel and tourism, on resident consumer behavior, on job posting in terms of the data we just looked at, but it's having larger impacts in the labor market as a whole. And those, what I want to do here is drill down a little bit in there so that we can map that into potential housing market outcomes as a consequence of these labor market changes, some of which are temporary, some of which may well turn out to be permanent. That is, they're going to persist in a different post-COVID configuration than the world or the labor market as we knew it pre-COVID or before 2020. So lower labor force participation and employment to population ratios, way more job openings given the unemployment rates we observe, people quitting their jobs in numbers or proportions of the workforce that we've never seen before, and remote work is here to stay. So let me walk you through some of these data sets. Labor force participation, the proportion of the population that is an active labor force participant, and the employment to population ratio, both look like they're settling post-COVID, right? You can see the initial COVID impact and then the recovery over the last 2 years. You can see them settling a percentage point or two below the pre-COVID benchmarks. And it's true that some of these numbers were declining pre-COVID as well. So for example, labor force participation, which rose from 1960 to 1990 as women entered the workforce in much larger proportions than had historically had been true outside the World War II era. Those numbers peaked in the early 1990s. And then of course, because the men are losers, they all started quitting, exiting the workforce, and aging has contributed to that. So there was a downward trend in labor force participation pre-COVID. And to some extent, this may simply, glom onto that previous trend. You can see that trend in the upper part of this slide, which illustrates another aspect of labor force participation, which has only recently been clarified in the labor economics literature. This is from a paper that was presented at the Fed's Jackson Hole conference last year. Anyway, you see those backwards Nike swooshes, the upside down, the U-shaped swooshes at the right end of the slide, a swoosh in the 20-teens. This phenomenon evidently was not identified as clearly over the prior 20 years. In previous decades, or for the last half century, partly because of this phenomenon of increasing labor force participation among working age women, as each business cycle came and went, the swooshes were upward, right? Because each economic expansion, more women than previously was the case, were becoming participants in the workforce. But we've maxed that out now, and as we move, partly because of aging in the population generally, the boomer generation moving towards retirement, the downward trend, which again has been pushed even further by COVID, probably has been pushed further by COVID, maybe by a percentage point, is now, or maybe revealing this downward swoosh that would imply for the 2020s a much harder time getting people to enter the workforce or re-enter the workforce, if in the case of people who have left the workforce. And by the way, each of these slides has a reference at the bottom if you want to actually look up the stuff, or your kids are writing a term paper for college, and so you can explore some of these issues on your own if you're interested. Some of the key takeaways I've highlighted: the labor force participation is likely to lag the recovery, economic recovery generally, was the consensus of the authors in this recent paper. But continuing on to the Hawaii data, and by the way, these are the Hawaii data. The paper has a methodology applied to the national data. I faked it and applied it, a version of it to the local data. But in the other local employment data, jobs are stuck at about 90% of pre-COVID, and jobs fell further on the neighbor islands than they did on Oahu. But again, in both cases, the recoveries, if you index to the end of 2017, as I've done here, the jobs are stuck at about 90 to 95%. And you just don't have the look of, strong recovery forthcoming. And of course, now with what's going on with interest rates and inflation fighting monetary policies, it's not clear the recovery will maintain the pace that it initially experienced in the second half of 2020 and for much of last year. Our exposure in Hawaii to the impacts of COVID and the nature of the uneven nature of the recovery and employment. Again, these are indices of job counts in this case by industry. The nature of our exposure is that the tourism complex, so over on the right-hand side of your screen, transportation, accommodation, retail jobs were hit the hardest. And of course, in industries in which remote work or telework was more feasible, or where there was a critical need for people to continue working. So for example, in health, but also in public services, as well as professional and financial services, somewhat more resilience in the event of the COVID shock itself, and then during the course of the recovery. And we have additional data that's now out there. Post-COVID, a bunch of this new data has shown up. These are data from compiled, from Earnin, Intuit, Kronos, and Paycheck. A group at Harvard and East Coast colleges puts this website together. But these are employment changes relative to January 2020, again, relative to the pre-COVID benchmark, so that's 0. Changes by wage quartile. So if you think of the high wage earners being the top quartile, the low wage workers being the lowest quartile, and then the middle wage earners being the middle 2 quartiles, right, 25 to 75%. You can see that recovery, the high wage workers had a more resilient experience to the COVID shock itself. Lower and middle wage workers had the biggest decreases. Uniform recovery, although not in equal proportions of previous job benchmarks or employment benchmarks through last summer. And then when these waves started hitting with Delta and then Omicron, again, some vulnerability on the low wage and middle wage side of parts of the spectrum. So that again, just by this particular measure. This is different from the official government data we're looking at, but these are all, you know, online employment services operators showing about 90%, maybe 80% to 90% of pre-COVID employment. Now, because the low-wage workers were losing their jobs more than the high-wage workers immediately after COVID, it meant that average wages actually went up. These are Oahu real wages, hourly wages, and then of course in the recovery, as low and middle wage workers got their jobs back, the average wage came down. Most recently, in the last 12 months, right, inflation has been eroding real wages, which have fallen through the 95% confidence interval around the trend of the 20 teens, about 2% real wage growth in the 20 teens. So it's overshooting to the downside already. It remains an open question whether real earnings growth or real wage growth in this case will return to that 2% trend. And we're going to see a number of data sets that, you know, raise similar kinds of questions for us to confront, and you know, frankly, for policymakers to confront, although nobody running for office right now seems interested in talking about it. Unemployment, which was down to 4% again in Hawaii as of May of this year, which is low, but not as low as the 2 to 3 percentage points we had pre-COVID, has begun to stabilize. But again, one of these labor market anomalies, it used to be the case that when you got to 4% unemployment, so 4% of the labor force was out of work and looking for work, that typically you have about 3 to 4 percentage points of jobs open, right? So a lot of people who are unemployed are, I mean, I know it's a joke to say you're between jobs, but it turns out that many people who are out of work and are looking for work are literally between jobs. And so it used to be the case when you had 4% unemployment, you'd have 3 or 4% of jobs were open, you know, literally waiting for them or waiting to be filled by people who were looking for work. But today that number is like 8% of jobs are open. So job openings are a much higher proportion relative to the historical relationship with the unemployment rate. And this has been true throughout the post-COVID period. It's true nationwide. These are Hawaii data. So what's happening, you may have heard about this elsewhere, and you're experiencing it, right? It's hard to find qualified people to fill positions, and there aren't any pilots left, and et cetera, et cetera. Part of the reason that's true is that in the post-COVID environment, people are quitting their jobs. Voluntary separations are about a percentage point higher, kind of on trend, but in many months since COVID, much higher. These are, again, Hawaii data. In fact, in many months, Hawaii's been the highest state in the country for quits. And there's a weird pattern. You can see I've highlighted the September numbers for both 2020 and 2021. We'll see what happens this September. For some reason, people quit their jobs in September. But yeah, that's a thing. So lots of job openings relative to the normal relationship to unemployment. And, you know, a lot of people saying, take this job and I quit. The flip side of that, maybe, I don't know, what's going on here? These are applications for federal employer ID numbers. So these are, think of them as business startups. Post-COVID, there's a huge leap in the number of people filing for a federal EIN. And I thought it was going to come back down, and it's like L-shaped. It's stayed at the higher level. So this is remarkable. People are quitting. Maybe some of them are starting new businesses. It's a work in progress. It remains to be seen. And moving back to Hawaii data, those are national data again, but moving back to Hawaii data, returning to the smartphone mobility data for Hawaii residents, you can see how much less time people spend in traditional workplaces relative to the pre-COVID norm, relative to January 2020, and how much more time they spend at home. So about 6.5% more time at home, about 30% less time in conventional workplaces. And again, some response to the variant waves, and in particular this spring, substantial decline, responding to the B8.2 wave that kind of interesting. Travelers didn't respond as much as workers did. Now, which brings up the whole subject of remote work. And then in a couple of minutes, I can get to a discussion about housing. So if people are spending 1/3, I'm not saying that 1/3 of workers are not spending time in traditional workplaces, but people in general, or their smartphones in Hawaii, are spending 1/3 less time in traditional workplaces than was true pre-COVID. So, maybe they're leaving their phones at home, I don't know. But pre-COVID, the benchmark was about 10% of workers worked at home some or all of the time. That is 90% or 89 point something percent of workers never or almost never worked from home. And pre-COVID, about 3 or 4% of workers worked from home full time, and another 6 or 7 percentage points work from home in what now people are calling hybrid arrangements. They go to work a few days a week, but not every day. Post-COVID, we can see, obviously, because of COVID itself, a couple of years ago, there was a huge leap in telework, as the Bureau of Labor Statistics defines it, but working from home, or what used to be called shirking from home, and remote work, another way people like to characterize it. And predictably, as economic recovery and vaccination and better understanding of the nature of health and safety protocols, mask wearing, and social distancing and whatnot, people have returned. Some people, most people, or many people have returned to conventional workplaces. But you see now that in addition to the 10 percentage points of people who work from home sometime or all the time pre-COVID, another 8 percentage points as of May of this year are working from home because of COVID. So in addition to the 10, there's this other 8% nationwide. And the pattern is clear that persons with higher educational attainment are more likely to be working remotely, and those with the lower educational attainment don't have the same opportunities. We observe that more women than men are availing themselves of the opportunity when presented to work from home across every age group, or almost every age group, or close enough that you might as well just say every age group. And we observe that millennials are participating, when the opportunity exists, in remote work more than boomers, who we've seen in some of the other data, or suspect are among those most likely to leave employment voluntarily. And those are national data. We also have some Hawaii data that are of interest here. These are slightly different from the data sets I was reporting a second ago from the Bureau of Labor Statistics. These are results of surveys, of kind of flash surveys of the Bureau of the Census in what's called their Household Pulse Survey. And they change the question from time to time, which makes it difficult to interpret. But let me explain what's going on in just the last part of this time series, where you see a black dashed line ending at about 30, it's about 33%, call it 1/3 of people fall into the category that's given by this black dashed line. And that's a kind of a proxy for not working in a conventional workplace. Specifically, the question to which people responded is the answer to, how many, or I'm sorry, the percentage of households where the percentage of adults in households where someone worked on site at a workplace in the last week. Now, the survey suggests about 66% in April and May lived in a household in which somebody worked on site at a workplace, which means that if 2/3 were working at a workplace, 1/3 were not. But of course, 1/3 of those adults living in households where people did not work in a workplace include retired persons who wouldn't have worked anyway. So let's take off another 5 or 10 percentage points. And then there's some people who don't have to work and need a false crack. So that still leaves you with, 20 or 25% of the workforce that is, or 20 or 25% of adults who live in households where nobody works at a workplace and aren't retired or have some other reason, like extreme personal wealth, to not have to work at all. And in fact, briefly a year ago, the Census Bureau actually did conduct a survey with that question, and that's that between spring break and the July 4th jump gap I show in the data here. There was that blue segment that indicated that was an indication of proportions of households with adults who telework because of the coronavirus. So I'm thinking the number's 20%. And we do have some data from 2021 now. Again, these are more COVID oriented, and what we're interested in is sort of what's post-COVID. We're still in transition, but what's post-COVID going to look like? You can see by industry that in the 2021, a relatively extensive survey nationwide, that large proportions of persons in information industries, professional and business services, financial services, etc., were working all of the time or some of the time remotely. And those at the bottom of the hierarchy I've shown here in accommodation and food services, in agricultural and natural resources, mining, construction, and so on, retail, manufacturing, transportation, where people are more likely to have to be in an actual workplace to be productive, that remote work is quite rare. Most recently, so these are now May 2022 data, working from home by industry. So we looked at educational attainment, we looked at gender, we looked at age cohorts, millennial women, highly educated millennial women are probably the most likely to be working at home. Well, by industry, again, finance and insurance, professional and technical services and information industries, along with public administration and a few others, seem to have high representation of, what's this about? My thing is blocked. Of telework, and then accommodation, agriculture, construction at the bottom. And by occupation, we also see that nerds rule. So occupations in computer and mathematical or computing and mathematical occupations, legal, business, financial operations, and so on, science, architecture, engineering, etc., we find more prevalent telework. And then in less prevalent industries, agriculture, food preparation, construction, and building maintenance, et cetera. A survey this spring looking at commuting patterns nationwide suggests, in terms of an outlook now, sort of looking forward, that maybe 2/3 of persons will continue to, or workers will continue to commute. So the 2/3 of employment will continue to involve full-time commuting. About 25% would be engaged in hybrid arrangements, and another 10 or 15% in full-time remote work. So let's think about housing for a second. What are the spatial implications in a world in which 3/4 of workers in February 2020, right before COVID, 75% of workers commuted every day, versus a world in 2022 expected to exhibit 63%, something less than 2/3, between 2/5 and 2/3 of workers commuting every day, and a much larger group of people, in hybrid arrangements, and almost double the number of workers, or double the amount of employment that's engaged in remote work full time. That's a different kind of a world. It has different spatial implications. There's an additional 5, maybe 10% of the workforce that no longer needs to be in proximity to a conventional workplace at all. You don't even have to be in the same state, not to mention the same island. And then a significant increase in the number of persons who, because they are more likely to be engaged in occupations or industries that enable hybrid work arrangements, where commuting is limited to, let's say, 2 or 3 days a week, those additional persons in that category have an opportunity that they didn't have previously to contemplate maybe living further away where the commute is longer but less infrequent. Do you see what I mean? So you'd expect the spatial pattern of housing demand to be materially influenced by this change in the nature of the workplace and the workforce. And it's probably something that's here to stay. In fact, the way the commissioner of the Bureau of Labor Statistics puts it, I've highlighted something he said in a webinar last year. The changes already are noticeably permanent in certain areas, not everywhere. And that we're not going back to normal. I mean, this is normal. This is the new normal. His opinion was that the workplace is changing faster today or last year than at any time since the Industrial Revolution. So this leads us naturally to an interesting exploration of possibilities, and I can't find my mute button, so I'm going to cough. Sorry. Apologies, my bad. There are sort of two extreme views, and then a lot of people sort of clustering in the middle. One view articulated early on is associated with an expression called the donut effect, where people leave the urban core and they move to suburbs and exurbs and Zoom towns across America, right? Coeur d'Alene, Idaho. What's the diff? And then another view, the donut effect, working from home, associated with Nick Bloom at Stanford. And then at Harvard, Ed Glazer, the author of two pop econ books, one called Triumph of the City and the other more recent one called Survival of the City, points out that, well, wait a minute, if a bunch of people must have moved, you know, to Windward, Oahu, or North Shore, or East Honolulu, and leave the urban core, by bidding up relative prices in those areas and leaving relative prices in the urban core not as profoundly affected, the urban core all of a sudden becomes relatively attractive to a different profile of buyer. See what I mean? So if the old fucks are moving to Hawaii Kai, then maybe there's a bunch of millennials that are going to move to Kuriamoku Street. And so we're watching this unfold. There is a new paper at the Federal Reserve Bank of San Francisco, and I've got the links here if you want to explore this, where the authors, in a very carefully designed analysis of the data, right? The problem here is you've got people moving around and you've got to sort of isolate the effects that are associated, right? We have migration data and we have remote work data, but in putting them all together, you have to isolate the people who migrated because of remote work in one direction versus another and all this other jazz. Bottom line, perhaps half of the 20 to 25% home price appreciation nationwide, there's a cross-section study across the country, perhaps half of the home price appreciation last year was attributable to the change in remote work. So with that sort of theme or literature in the back of our minds, let's take a look at what was happening on Oahu in the last couple of years. And I've been, I should acknowledge Cheryl over at the Honolulu Board of Realtors, who it takes her like 30 seconds to respond to my request for data. So mahalo, Cheryl Enriquez. And now I'd done some of this work last year for the Hawaii Association of Realtors webinar we put on. And so I've got another year of data. The results on the contest I changed a little. I'm not sure why. I might have got it wrong last year. That could be why. But still the main effect comes through. So I've taken all the data for Oahu and I've broken down years ending in March, right? So from April 2019 to March 2020, I call that pre-COVID. And then from March 2020, from April 2020 to March 2021, I call that year one of post-COVID. And then from April 2021 to March 2022, I call that year two. And I've estimated the underlying truncated home price distribution. So I truncate graphically, I truncate at 3.5 million. So that's where the cutoff is on the right end of each chart, right? These are like remember when you took that horrible econ class in college, these are the exam scores, and all of us are dummies down here at, 500,000. 500 is a $500,000 condo or a $500,000 house. And then the height of each distribution is the frequency at which that price is observed relative to the other prices, 1 million, 1.5 million, etc. And so now that you've sort of had a chance to let it sink in, basically what you see is that single family home prices busted a big move. They busted a move going from pre-COVID to year one, more sales at prices around 1 million and under, yeah. So the first shift, but then the second shift was a huge punch out in prices over 1 million, way more transactions in prices over 1 million. And of course that translates into a median that, right, the halfway point, moving over 1 million. On the condo side, not quite as much energy, right? Sales in the lower price portions of the distribution declined from year to year. That's true, but they didn't go up as much, as vigorously as in the higher priced units. So the big action was on the single family home side of the market. And we can just see that if we look at neighborhood detail, I've shown this to you before, but just as a repeat, in 2020, the neighborhoods, right, the spatial impact, the donut effect, which I alluded to a second ago, on Oahu was on the North Shore, East Honolulu, and windward Oahu, the highlands, right, Mililani, Makakilo. And then where were prices falling? These are single family homes now in the urban core. And I mean, how many single family homes are left? But I'm just saying that happened. 2021, which I'm not showing you, a much more heterogeneous pattern. That is, this looks like it was a one-time shift that then began to dissipate last year and is probably over. And so when we look at the median prices themselves for single family homes and condos on Oahu, you see this, the arc of what everybody was asking me about last year. Is this a bubble? Is this a bubble? And last year I was looking at it going, if it's a bubble, then why is it affecting only single family homes and not condominiums? That is to say, when it's a bubble, like the Japan bubble or the subprime bubble, where it's not connected to economic fundamentals, right? The problem with the bubble is that it's some wacky thing that's going on in people's heads. It might have been stimulated by something like Japanese investors or subprime mortgage lending, but there's not an actual economic fundamental explanation that in which these price movements are well rooted. Here, what I'm suggesting is there is an economic fundamental explanation, a shift in buyer preferences, a shift in the demand for housing towards detached dwellings, towards suburbs and exurbs and zoom towns, and at least initially away from the urban core and away from multifamily dwellings. Now you can see condo prices this spring have risen back up. And if you're looking at the volumes, obviously, they're the cheap units. And so last year was a huge year for condo sales. But in terms of the valuations, condos on Oahu really just returned to the pre-COVID trend. This is the trend from about 2012 to 2018, whereas single family home valuations punched right through the trend, punched right out of the 95% confidence interval, and punched well above trend. Now, the question you reasonably would ask is, where do we end up? Is this, if it's not a bubble, but it's bubblicious on the single family home side of the market, then are these prices going to collapse? I don't think so. I think you can see that there's an arc that I've added. I ran a second regression. You can see there's a curvature there. And when you look across all the islands, you see the same kind of curvature, in single family median home prices on Oahu. You see in single family median home prices across the islands. And I've highlighted the one on the Big Island at the bottom because it's isolated. But Big Island is really like 3 islands, right? It's Hilo, Kona, and People's Republic of Kau. If you put Kona together with Maui and Kauai and Oahu, it's indistinguishable. Kona is the same as Kauai and Maui and Oahu. Hilo is its own private Idaho. And so the average of Hilo and Kona with a couple of Kau prices thrown in for good measure leads Big Island to be well below their counterparts. But again, we're talking about the dynamics here. The point is that it's not really a bubble. It's bubblicious in expression, because it's a representation of this underlying shift in economic fundamentals, shift towards remote work. And I was just over on Kauai the other day, so I'll show you their data, because for them I did a special thing. And it's, again, the same picture you see on Oahu, where, with the exception of the last couple of months, and these are very noisy time series. But again, that arc of the single family home price trajectory busting a move, in that case from the lower to the upper end of the 95% confidence interval from the 20 teens. So how does the short term fit into the long term? Well, in terms of the long term for California, and Hawaii is the western edge of California, Oahu median single family home prices going back over time are still, the same as Orange County. In the bubblicious period in the late 80s, to which I refer, the Japan bubble, Oahu had its own thing, like more Japanese investors than Orange County. And so Oahu did break away in that particular bubble. In the subprime bubble, which was a shared experience, Oahu was not as bubblicious as the rest of California. And of course, it was out of control in California. And then there have been other bubbles in California, the dot-com bubble in the late 1990s, which affected the Bay Area more than elsewhere, although it was a California-wide experience. And then we had a little unicorn bubble in the 20 teens, you can see showing up in the Santa Clara County prices. But all in all, I would say, again, Oahu in this case, pretty much moving like the rest of coastal California, where these same forces of remote work may have been active. I'm not going to assert that, but I would hypothesize, if you looked into it, that suburbs and Xers and Zoom towns were exhibiting the same phenomenon there. And in fact, I've been hearing a lot about, like at the extreme version is people who worked in the Bay Area, and then after COVID, they moved up to Tahoe and spent a couple of years hiding out up there. But they kept their home in the Bay Area because they're that rich. And so now they're trying to figure out where they're going to live. In the longer run for Hawaii specifically, comparing Oahu to Maui, which is now a city, the Kahului Metropolitan Statistical Area, and I emphasize metropolitan, and the non-metro portions of Hawaii, you can see they too were more bubblicious, that is outside Oahu, in the subprime bubble, which I haven't identified, but you can see it there in the early 2000s. And maybe a little more bubblicious most recently, but if you adjust for inflation, my sense of what's just happened is that it's not a bubble like the prior bubbles. So I've taken the inflation out of these FHFA valuations. These are from mortgage collateral valuations, by the way, and a much broader sample than existing home sales. In fact, it's every mortgage. And so we've moved back to trend. I think that's probably a theme for this decade, that to the extent single family home prices got misaligned because of the post-COVID adjustment, they will realign with trend. They could just simply stay where they are for a couple of years, because the trend was going to get, to 1.25 million or whatever, eventually, like next year anyway. Turning finally to interest rates, it's 2:30, so this seems like a good time to wrap up, and my timing seems pretty good. As I say, I got an email from Patrick this morning, with whom I've been having this conversation now for a couple of weeks. And Patrick, a couple of weeks ago, was like, can't you show a regression that says, he didn't actually say regression, but I know he meant it. Can't you show that when mortgage rates go up, home sales go down? And I kind of, on the fly, we did something in what you call the podcast that was kind of junk. But
by the way, Paul, that is not what I said. So I'll correct you later.
But you asked something about mortgage rates going up and the sales going down.
Well, there are times when rates are going up. However, sales volume is very strong.
Well, and that was true.
Inverse correlation. Yeah, sorry, continue.
No, but this is a really important point, and thank you for the clarification, because it turns out it's not as straightforward, but eventually it's going to catch up to you. So let's take a look at that. You all know the history of mortgage rates, and as Anders pointed out, today we're up in the high fives. This is for the week ending today, but it's been going up. So although it backed off a little in the last couple of days. Just a quick reminder, if you adjust for inflation, if you just these nominal interest rates for the contemporaneous consumer price index measure of inflation. Now that's not really a good way to do it because it's inflation expectations that matter. But if you use as a proxy for expectations, the current inflation rate, a really bad proxy, you see that real interest rates right now are still negative, are actually negative. I'm not still negative, but are actually negative, meaning that the inflation has surged upwards so quickly that it's gotten ahead of the Fed, who signaled to us that they were going to raise rates, and as a consequence of which, bond traders in treasuries markets, and mortgage lenders, because of arbitrage, all were responding with higher long-term interest rates. It turns out the Fed may not have been moving fast enough or as fast as people thought, or for whatever reason, real mortgage interest rates are actually negative, and way more negative than they were in the late 70s when we had a much bigger inflation problem nationwide. And you may remember there was a lot of inflation hedging going on. It was something that happens when you have a sudden inflation or an accelerating inflation that's ratcheting upward and feeling like it's going to be persistent. People flee to the safe haven of housing as an asset class because it's a real asset. And you may not be able to protect yourself or hedge against inflation in other asset classes, but you can live in a house and it's still going to be a house no matter what the inflation rate is. So we're in this weird sort of anomalous moment, which what's important about this, and we could develop it a little later, it's in an appendix on inflation. What's different about the inflation now is that it's happened very quickly. It's not when people say, well, it's the highest inflation rate nationwide in 40 years, what they mean is the last time inflation was this high, it happened over a period of a decade or 15 years. In fact, each of the last 3 inflations in Hawaii happened over intervals of at least a decade. That is a 10-year-long crescendo leading to high inflation. The inflation we have right now happened in the last 12 months. It happened since March of last year. When I say 12 months, I mean you have to look at the May statistic from a year ago and the May urban Hawaii Consumer Price Index to see it. It just happened like a light switch, which suggests it's different from the prior inflations. But we can talk about that more in a second. Because it snuck up so quickly, it's made this mortgage rate negative. Now let's just contemplate a couple other aspects of mortgage rates here, which are the spreads, right? Is there a risk premium that we should be concerned about? Is there an inflation risk premium? It turns out not so much. We can talk about that. I've left it in the appendix. Here we're looking implicitly at credit spreads. So I've got a slightly different mortgage data set that Fred, the Federal Reserve Bank of St. Louis data website, Fred II, acquires from an outfit called Optimal Blue. So these are conforming mortgage interest, 30-year mortgage interest rates. And then the one at the top is a conforming with a LTV of no greater than 80% and a FICO score below 680, right? So, comparatively higher risk credit, let's say. And the question I'm asking here, obviously they've moved with treasury yields, and I've used the 7-year constant maturity yield as the risk-free benchmark against which to compare these conforming mortgage rates. And the answer is yes, the risk premium has moved up. So it's not just that interest rates are going up, but perceptions of risk has moved up. Well, you knew that looking at the stock market for the last 6 months. You knew that looking at the Russian invasion of Ukraine. You knew that looking at the clowns on the U.S. Supreme Court that are making these crazy decisions, right? So there's something going on. in people's heads, and it's contributing to an increase in the risk premium, you know, of maybe 50 basis points, maybe 70. And ordinarily, we ought to have about a 200 basis point spread in conforming mortgages to the 7-year yield on the 7-year note. And the reason I use the 7-year is the average life of a mortgage is about 7 years. So finally, before concluding, turning to this question of the relationship between interest rates and sales volumes. On the horizontal axis, I've got the mortgage rate, right? So 3%, 4%, 5%, 6%. On the x-axis, I got the mortgage rate, and then on the y-axis, the vertical axis, statewide. I'm using statewide existing home sales data, all 4 counties. Patrick and I looked at Oahu the other day. And I illustrate 2 ways to think about the relationship, sort of broadly speaking, in the scatter plot, right? Both of which tell you higher mortgage rates. When you go from 3% to 6% mortgage rate, sales tend to decline. Each percentage point increase in the mortgage rate is associated broadly with about a 15 to 20% decline in sales volume. So a 300 basis point increase, doubling the mortgage rate from 3% to 6%, should be expected to reduce sales by about half. I mean, if you sort of add up the cumulative effects of the elasticity, so to speak, well, as Patrick suggested in our earlier conversation, it's not like, you know, it's not purely mechanical. And in particular, if you connect the dots, now here, same dots in each picture, but connect the dots and you see across the top of the frame a horizontal line from October 2021 to May 2022. That is, even though mortgage rates were rising, sales of existing homes in Hawaii, single family and condo, total sales remained about the same between October and May. So what's going on? Well, wait 5 minutes, because what I think is happening now is that it's making a right turn. And if you look at the pattern generally, right, it looks like your brain on drugs, but when you connect the dots, you can see there's kind of a clockwise spiral that eventually shows up. So for example, between 2008 and 2009, sales were declining at a time of the Great Recession, right? Even though, and for the same reasons, because of recession, interest rates were falling. So I believe that this clockwise cycle, if you will reassert itself, and that May 2022 is the beginning of a right turn that sees sales dropping now that interest rates are up in the high 5s. That is the plateau to which home sales had held up, and maybe were higher because of remote work and a one-time shift in the way people, you know, some people are working and the change in their housing preferences. But that's probably over now. And the higher rates, combined with other factors, right? The US is probably moving closer to economic recession than before. Investors, understandably, are more concerned about what's going on, certainly in equity markets and geopolitically, not to mention biologically in terms of the pandemic. And then finally, we were just looking at risk premia. Risk premia in mortgage lending itself is higher. So there's a perception of risk that may lead investors to pull back. So I'd expect months of inventory remaining to begin drifting upward from the crazy, crazy low place they occupy. These are Oahu data, you know, with 1 month of inventory remaining in the single family spectrum. And slightly higher inventories in condos. I'd expect both of those to start piling up. And this is my slide with the old surfing expression, dude, you should have been here yesterday. Because for all the people that were complaining about affordable housing in Hawaii, you just missed it. Window of opportunity closed when mortgage rates went from 3% to 6%. So you have to wait a couple of years before the opportunity reopens. And I'm going to push through now. The supply side, there is no supply. We don't build houses. We just renovate them. We just pimp out home offices. So, well, except for Howard Hughes. So the outlook is, it's kind of meh. It's kind of, I don't think there's going to be a train wreck for housing. I don't think there's going to be a big implosion in valuations. But of course, bad things could happen. Russia invaded Ukraine. Who came up with that? And still, I think the economy, while in pretty good shape locally, and it had a worse time than the nation, has not gotten all the way back. It's stuck. I call it this, the 0.9 problem, and we're going to have to work through that part of it, and we could talk more about that in the Q&A if you want. I've got like 2 Q&A questions and 35 comments in the chat.
Well, Paul, I'm gonna bring it down because I've also got some direct that have come in.
Can you summarize?
Yeah, so I'm just going to summarize a few, and thank you for everyone that's been sending to me and putting in the chat in the Q&A. Let's just start for a moment with interest rates. Earlier, we were looking at the chart that you sent me this morning, and it looked like the run up to the subprime when I don't remember anyone talking about interest rates was higher than they are today. So certainly that's a time with high sales volume with higher rates. The quote Japanese bubble period, I think it was close to 8-9%, maybe even higher during that period. Again, I don't remember anyone talking about interest rates. What would be considered a normalized residential mortgage rate for a 30-year? Is there something that the Fed is targeting? Is there a way to look at that? And if we hit that number, we say this is what it should be, and this is high, this is low.
Yeah. You have to remember, most of what we're seeing here in nominal interest rates is a reflection of the Fed's successful management downward of the inflation rate itself. So from double-digit rates, the Fed moved to lower inflation, achieved lower inflation through appropriate conduct of monetary policy. And in the last decade has settled with an inflation target around 2%. Now let's think about the last decade, because your question is, well, what is the new normal, if there is a new normal? And if the inflation goal is 2% and the Fed is credibly committed to that goal, and people perceive that commitment to be credible in the sense that if you look at inflation expectations, they're well anchored around the goal, the stated goal of 2%, not that much higher, a little higher right now, a little higher in the near term than in the long term. Then a 2% inflation rate, which was credible pre-COVID in the last decade, in the longest expansion in U.S. history, was observably consistent with a 4% mortgage rate. See that? That 4% horizontal line, that's what we lived in the 20-teens when the Fed's explicit inflation goal after January 2012 was 2%. And whatever else was going on in the world, and there was always something going on in the world, was having at us. And mortgage rates were about 2 percentage, right, 200 basis points above the Fed goal, which, there you go. They're the 2 percentage points of real interest. So that's an interesting way of approaching the question, but we can look further into some of the details, and these are in the appendix, so I'll have to go forward. And let's just think about what the Fed is actually telling us, which is that, right, so they use forward guidance to let us know what they think is coming and how they will respond in the event things work out the way they expect. They use the balance sheet to provide liquidity to the financial system and when it's needed in a crisis, and to influence long-term interest rates through their purchases of U.S. Treasury securities and mortgage-backed securities, right? And then they manipulate and provide us with an explicit target for the overnight Fed funds rate from which the market, the system overnight funding rate is going to arbitrage. They pay interest on bank reserves you see here. So all the liquidity is sort of aligned. And they tell us what their own expectation is for the overnight rate, as I've illustrated here in the dashed line, over the next 3, 4, 5 years, or over the next 3 years, and then what their longer run expectation is. And their longer run expectation, looks very similar to me to where they ended up after a period of interest rate normalization in the late 20 teens. You see that? In the late 20 teens, where they normalized the overnight rate to a point of about 2.5%, which now their expectation is 2.3. So yeah, you could get, and then at that point, the yield curve would be relatively flat, right? It would be in principle at or above the inflation goal by a small amount, which is dictated by productivity growth, and productivity growth now is lower than it used to be because of Facebook and smartphones, and I don't know why, but it's lower than it used to be. And so we could be going back to the same world, Patrick. And if the overnight rate and the term structure of interest rates were 2.25%, and the historical relationship between mortgage rates and in a risk-free environment was about 175 basis point premium, then that would 225 plus 175 basis points is a 4% mortgage, or maybe 4.25, right? If 200 basis points.
So Fed fund rate plus 2, or one time we talked, inflation plus or minus a premium, but a long-term, if 2 is the number and the number is 2, which I've learned from you, right, that rates would probably be a normalized long-term residential interest rate, maybe 4.5%, something like that.
Yeah, 4 to 4.5.
Okay. All right.
And, I mean, that's what I'd be looking for overshooting, right? We just saw mortgage rates go and knock on 6%, knock on the door. But that's part of the same overshooting that the Fed is signaling and indicating explicitly, right? Their own forecast is that the Fed funds rate will overshoot 3.5%, maybe 4% before coming back down.
So Paul, let me segue then into the next round of questions, which have to do with inflation. Can you talk a little bit about the causes of inflation this time compared to historical inflation causes? And will the Fed's action really have an impact on this? By raising the rates, will they be able to affect inflation rate?
So, the bumper sticker, this not the mainland? Same with inflation, this not the mainland. So, U.S. inflation is higher than at any time in the last 40 years. Hawaii inflation isn't even as high as it was 30 years ago. So this is not the mainland. But I just read inflation in Austria is 7%. And it's 7% in the urban Hawaii Consumer Price Index as of May of this year. So this is not an American phenomenon, right? Inflation is everywhere. And for the same reason. It's the pandemic, stupid. No offense to anybody in particular. In particular, it happened really quickly. Much of it's rooted in supply chain disruptions that have nothing to do with the presence or absence of federal fiscal stimuli and whether they were too big or organized improperly. And I want to illustrate here, these are and my estimate combined with the Bureau of Labor Statistics official estimate of the urban Hawaii, it's now called, and formerly the Honolulu Consumer Price Index inflation rate. The current inflation, right, that you see that light switch that just toggled upward, it looks very much like the inflation which accompanied World War II, the inflation which accompanied demobilization post-war in the late 1940s, that associated with the Korean War, and whatever happened in 1958 that I don't know. Like, it's not the consequence, as I indicated earlier in my talk, of a 10, 15 or 20-year-long crescendo of factors that are cranking up the inflation rate. Now, it is lower than nationwide, although not much, but enough that it matters because it used to be the same. And if you decompose it into taking the so-called headline inflation rate and removing food and energy costs for people who don't eat or drive, then the core inflation rate of the 7 percentage points, the core inflation rate is about 4 percentage points. And then the sort of the supply side, right? Think of that as the aggregate demand side, the economy, rip-roaring economy or whatever it's supposed to be. And then the supply side is the other part. Well, you can see that if you break down the components of the Honolulu Consumer Price Index inflation rate for May of this year, for last month. And it's a bi-monthly measure, so we'll have another data set when the July data come out in August. But clearly, above average, you see three categories: liquid fuels, food, and then vehicles. What's that all about? Well, that's totally supply chain disruption.
So with all of that in mind, will the Fed's actions have any impact?
Will the Fed's actions have any impact
on the interest rate if this is a if the supply chain issues are inflation?
Yes, I'm rhetorically answering your question with an answer. With the question, will Federal Reserve monetary policy, or for that matter, anybody else's monetary policy, have an impact on foundries in Taiwan that make semiconductors that were supposed to go into motor vehicles, but instead went into the laptops everybody bought when they pimped out their home office and homeschooled their kids for a year? Probably not. Will it affect the grain will the Federal Reserve and monetary policy making elsewhere affect the grain harvest in Ukraine this summer? Depressed as a consequence of the invasion? Probably not. You get the picture.
Yeah, of course.
Yes.
Okay.
Will oil prices, what does the Fed have to do with oil prices? Nothing. Which, by the way, are back to where they were 10 years ago. And here's an important thing to remember. Even if, in the worst case scenario, oil prices stay where they were 10 years ago, which they were 10 years ago, and nobody had a cow then, if they stay there 12 months from now, the contribution of inflation from fuels will be zero. You see what I mean? So some of this is transitory, and what the Fed's working on, and there's all this, here, corn, I got lumber in here. Many of these things just require the supply chain to work out, and the other parts of which, the Fed is braking heavily to and trying to avoid recession. Let me jump to an implication of that, by the way, since as long as we're gonna.
Well, I want to get to one more thing before we run out of time.
Yeah.
You want to hit one more slide?
While you're asking the question, I'll go find the answer to the question you haven't asked.
Okay.
What's the question?
Okay. Okay. So the answer is,
here's the answer to the question you didn't ask. Okay. So GDP, right? GDP, this is what I call the 90% problem. We're looking at GDP in Hawaii that's 95% of what it was in 2019. But in 2019, it was lower than it was in 2017. And if you look at the gap between where Hawaii is now and where the track it was on, right before, I'm not blaming anybody, I'm just saying before MAGA world, then we're 15 percentage points of GDP behind the curve. That's tourism. We're the equivalent of another tourism from where we have the potential to be in Hawaii at a time when US GDP growth was negative in the first quarter and is probably nil in the second quarter. So what I'm saying is the soft landing that the Fed is actually, this is why we were just talking about Fed policy, the soft landing the Fed's trying to engineer to tamp down the inflation. No recession, just getting down to where there's no more inflation pressure from the macro part of the economy, so that as the supply chain is resolved, the supply part of it goes away. That over the next 18 months, this happens over, by the end of 2023, we'll get to a point where we came really close to recession, but didn't have one like in 1994 and 1995. But meanwhile, Hawaii is even further behind the curve than we started out. And that was true pre-COVID. So Hawaii has other problems than just dealing with COVID. Yeah.
Thank you for that. And let's just get this, probably our last question. And sorry, we didn't get to everybody's things, but we will. Long-term price line, long-term price trend line, single family homes.
Yeah.
Clearly it's busted way up above, right? Condos almost seem like it's below long-term trend line. Do you expect to see a regression back to that long-term trend line for prices on single family home in particular?
Yeah, no, let me, I did have that data set, and I think it is important to recognize that what I think is going on is that, yes, there continue to be variations around trend, but they seem to be of smaller amplitude. They don't get so far out of alignment that we're all thrown off for a decade or whatever. And in particular, we don't get so far thrown off that it takes us 5 years to claw back. You see what I mean? I mean, that looks really high, because what I've done here is kind of, you see how I not too subtly incorporated this curvature. Now, what's this curvature about? Partly it's about lower inflation today than in the 1970s. When I take out the inflation, I get that 2%. This is Oahu now. I get that 2% home price appreciation after inflation. There's that number again, 2%. And what we've seen is really kind of a return to where we would have been in the long run anyway. It's, as I say, the cycles just don't have the amplitude. That's a good thing. It doesn't get as crazy overboard. It doesn't have to pull back as far and then have a destructive interval we just had a destructive interval from COVID. We don't need another one right now. So it may, I honestly, I don't know, but I mean, I think some of the wind is going to be taken out of the sails of price appreciation, but I don't see a big implosion ahead. And the problem for the advocates of affordable housing development, and I would include myself among them, is that it's about affordable housing development. It's about, you have to build the houses, period. End of story. If you don't build the houses, you won't have them, because I'm not giving mine up.
Yeah, so, well, we've talked about that quite a bit, and
over and over again.
Yeah. So listen, we're going to have to wrap it up there. We're at 3 o'clock. As always, we run out of time, but it's been an absolute pleasure. Always so informative. And as I mentioned earlier, if you want more of Paul's wisdom, join us for the Hawaii Housing Report that's released each month on YouTube. You can also find it on our website. All the attendees here today, you will be receiving a follow-up with Paul's materials, as well as a replay of the video. If you happen to be watching this as a video replay, to make Paul happy, please give him a thumbs up below and subscribe to the channel. Paul, you're such a millennial.
I still don't know anything about TikTok or Instagram, and so I'm not making any money off of that stuff. But if you do have questions, some of you know how to find me, so send me an email and I'll see if I can help you out.
Yeah. So that's it for today, everyone. Thank you for attending. Thank you to the sponsors. Stay safe, be well, and aloha.
Aloha.
Thanks, Paul.